So right now in Washington, there's this massive, highly anticipated piece of crypto legislation that has just stalled out. Today, we're looking at the stablecoin stall, banking lobby versus crypto yields. It's an absolutely fascinating clash of titans between the traditional finance world and the emerging crypto economy.
Okay, let's dive into this. For months, the momentum behind this Stablecoin bill felt literally unstoppable, right? A lot of insiders were pointing to April as the finish line to get it out of committee. But now, we're hitting the brakes. The timeline's slipping, the rhetoric is heating up, and these massive financial interests are colliding behind closed doors. So why exactly is this highly anticipated bill suddenly hitting a wall and missing its April target?
Well, that brings us to Section 1, a delayed stablecoin bill.
To really understand this, we have to look at the structural hurdles first, namely a severely crowded legislative calendar. Originally, the Senate Banking Committee was targeting the week of April 27th to mark up this measure. But check out what else is happening right around then. In late April, the committee also has to hold a hearing for Kevin Warsh, President Donald Trump's nominee for Federal Reserve Chair. And look, a Fed chair nomination hearing, that is a monumental event. It naturally just sucks up a massive amount of the committee's oxygen, time, and resources. Because the calendar is so completely packed, lawmakers suddenly have way less room to settle their disputes over the stablecoin bill. The result? We're looking at a very likely slip into May of 2026 before we see any real progress.
Let's move on to Section 2, banks fight back on yields. Now, a crowded calendar is really just the logistical headache here. The actual roadblock is the policy dispute itself. To make sense of this fight, we really need to understand exactly what a yield-bearing stablecoin is. Basically, it's a digital token pegged to a stable asset, like the US dollar, that actually pays interest, or financial rewards, directly to the people holding it, kind of like a digitized high-yield savings account right on the blockchain. And it turns out this specific financial mechanism is the absolute epicenter of the legislative gridlock we're seeing. Which leads us to this intense tug-of-war in Washington right now. On one side, you have the traditional banking lobby. Groups like the American Bankers Association. They are fiercely urging Congress to place strict limits on these yield-bearing tokens. Why? Because they fear a massive deposit flight. Their argument is basically that if everyday consumers can just jump online and get better, easily accessible yields from stablecoins, they're going to pull their money out of traditional bank accounts at scale, and that could destabilize the whole traditional banking system. But then, on the other side of this tug-of-war, we have the White House. The administration is pushing hard to protect these consumer rewards, arguing heavily in favor of innovation and ensuring everyday people can actually benefit from the upside of these new tech tools. So it's this classic standoff, protecting the incumbent traditional systems versus fostering brand new rewarding technologies for consumers.
All right, Section 3, the White House response.
Now, what's really interesting about this is how the administration is pushing back against the banking lobby's fears by pointing directly to the math. Just listen to this direct challenge from Patrick Witt, the White House crypto advisor. He said, lawmakers should not delay the measure based on claims that conflict with the administration's own data. Basically, the White House is looking right at the banking lobby and saying, you know, your fears of massive deposit flight and systemic risk, they just aren't backed up by our economic models.
So the crucial point is this massive number, $800 million. According to a recent report from the White House Council of Economic Advisors, the CEA, this is the estimated net consumer welfare cost if lawmakers actually listen to the banks and outright ban stablecoin yields. By restricting these rewards, the CEA argues everyday consumers would collectively lose out on $800 million in potential financial benefits. The administration is essentially throwing down this figure and asking Congress, are we really willing to cost consumers this much money just to protect traditional bank deposits?
And when you dig a little deeper into that CEA data, the White House's argument gets even more stark. Let's do the math. If Congress banned stablecoin yields, the CEA estimates it would raise bank lending by about $2.1 billion. Now I know, $2.1 billion sounds like a ton of money to you and me, but contextualize that against the traditional banking sector's total loan book, which sits at a whopping $12 trillion. When you put those side by side, that $2.1 billion increase represents a microscopic 0.02% impact on their total operations. So the White House is using this exact comparison to argue that the traditional banking sector's fears of total disruption are entirely overblown and definitely not worth an $800 million hit to consumers.
Next up, Section 4, other unresolved crypto hurdles.
Let's move to the other roadblocks and see how this builds, because unfortunately for this legislation, the fight over yields is really just one piece of a giant puzzle. The sheer complexity of this bill is staggering. I mean, beyond the yield debate, lawmakers are still trying to hammer out rules for decentralized finance, or DeFi.
They're arguing over strict conflict of interest guidelines. They're debating specific ethics rules to govern whether lawmakers themselves can even trade crypto tokens. And hovering over all of this the whole time is the broader, continuous pressure from bank lobbying groups fighting to make sure innovation doesn't outpace deposit protection. Every single one of these bullet points represents hours and hours of intense negotiations and potential gridlock.
And that brings us to the actual boots-on-the-ground reality. Senator Thom Tillis, who's heavily involved in negotiating the specific language of this stablecoin bill, might hold another in-person session with industry participants to try and narrow these remaining gaps. Now, look, while it's fantastic that lawmakers are willing to do the hard work and get everyone in a room, practically speaking, scheduling another in-person session almost guarantees that this entire process gets pushed further into May. That April timeline we talked about, it is effectively off the table.
Which brings us to our final section, Section 5, the uncertain path ahead.
Even if Senator Tillis and his colleagues manage to thread the needle here, the structural path this bill has to run is incredibly long. Step 1 is literally just clearing the Senate Banking Committee, which, as we've seen, is currently bogged down by scheduling conflicts and this massive fight over yields. But let's say they pass Step 1 in May. They then move to Step 2, where they have to reconcile their version of the bill with whatever version the House of Representatives produces. And getting two divided chambers of Congress to agree on highly technical financial regulations, that is incredibly difficult. And only if they survive Step 2 does the bill finally reach Step 3, arriving on President Trump's desk for a final decision. When you factor in the packed schedule, the deep policy splits, and the relentless pushback from traditional banks, everything points to a much slower timeline than anyone originally anticipated.
So that leaves us with this final pressing question. How will President Trump and the divided chambers ultimately reconcile this high-stakes legislative tug-of-war? Are the traditional banks going to successfully defend their deposit base, or will crypto advocates secure a brand new era of yield-bearing rewards for consumers? The path forward is completely open, but it is entirely uncertain. I highly encourage you to keep your eyes on the Senate Banking Committee calendar as we move into May to see how this all unfolds.